we made it to the first lessons of this second session of StockSessions.com. We talked about stocks, we talked about bonds, different types of stocks, different types of bonds. We also discussed mutual funds, which is kind of a building portfolio for you. We also talked about ETF, which is kind of my preference, and most people that study these things and trade these markets, they tend towards ETFs as well. You don't have to, but it's available to you. We'll now finish up by talking about if you really don't want to do anything whatsoever, you don't want to research, you don't even want to buy a mutual fund, you can hire someone to do it for you. And a lot of people do. I have a money manager. I've had a money manager since college and all that. My family does. So this is not a bad thing to have someone manage a longer term portfolio. It's actually quite common. And you don't need a lot of money to have someone help you with your finances. Most people could use some help, and especially if you're making large transitions from college to your first job, from your first house you're buying to marriage, etc. Helpful just to do a checkup like you would a doctor to a financial advisor. Just get a financial checkup. Not that bad thing. And so you can do this on your own. You can, again, do a portion of it on your own. And then you can do any number of things from get advice to having a full portfolio built just for you. So we'll talk about finishing up with hiring a money manager or a financial advisor or a coach or whatever the case may be. You're going outside your own skills to someone with a professional designation and interest and knowledge specialized just as you would a sports therapist, a doctor, any number of professionals that can give you advice for a fee. And so what we'll talk about, this certainly is overwhelming to a lot of people. It's doable, it's a lot of work. And if you just don't like investing, you don't have to do it, but you do have to manage your money. Nobody can go through life just kind of without a budget, without income. You have to have something with your financial future. And the more planning and strategy that you do, especially when you're younger, the better it is when you are retired. That's fine. Professionals help you with this. You don't have to be Superman or Superwoman or Wonder Woman when it comes to managing a portfolio. Don't be a hero. Wall Street has a whole slew of professionals and companies and ways that you can have help. You don't have to be rich, but you must know how to spot the good from the bad. And there aren't really evil financial advisors out there. There are some with conflicts of interest. There are some that don't care as much, that don't have the passion, maybe even don't have the knowledge that some others do. So like anything else, there are good and, quote, bad, or at least better, people than others with this product. It's probably fun to have part of your money set aside. So you can do the same thing. So keep in mind, this is your life, your future, and you're taking control of it. So where do you start? There really are a lot of people. The first thing you would do is check with friends and family. And you would look on the internet now, maybe Yelp or whatever the case is, for local money managers or local financial advisors. Or if someone in your family or friendship circle or office circle, work professional circles, is or knows someone, that's usually where you start. Recommendations are key. There are so many people that do similar services. So start with recommendations first. You'll probably know somebody who has had their money managed by a financial advisor. It'd be rare if you did not. And you can choose advisors who work for its benefits or trade-offs, to work for a very large known company, or you may just be a number to them. So they might not be as attentive to your needs, or they may give you a formulaic response. I'm conservative. Okay, we're going to build a portfolio. And next thing you know, you said that we're conservative and you've got a portfolio and they don't really care. Well, you're paying for that service. So it's helpful to have at least a little bit of input. But the problem with that is the same thing. They'll have similar solutions and construct similar portfolios based upon what you tell them. Not that much individual. Nothing wrong with that, but if you want more individual attention, a large, big broker person is probably not your way to go. You have to communicate to them. So smaller ones can help with that too. Smaller ones will be more attentive. They'll usually be more professional, not professional necessarily, but they'll know your needs. They'll be able to work with you more individually. If that's what you want, that's fine. So the way you get services, think of how the person is paid. How are you paying them? The quality of their service, as sad or happy as it may be, will be determined on how they get paid. And we've discussed this with mutual funds. There are conflicts of interest that are inherent in the business, and you must be careful with that. Number one, if they get commissions, if you buy something, they get paid. What is their motivation? To get you to buy. Might it be the best thing for you? Maybe not. What if you need to be conservative and buy a totally bond portfolio if something's happened in your life? They won't tell you that. They'll say, you should buy this. You should also buy that. You should probably buy this too. That could be a conflict of interest if you're paying just commissions, an annual fee. If you invest money with them, they get paid. So you put $100,000 and you say, manage my portfolio, manage my money, do it yourself. They will get paid for that. They will take just like the mutual fund, but this time you actually see them. A mutual fund is where you pay a fee to an unknown entity to manage your portfolio, essentially. This is where a person or group, maybe use a person, will manage it. They want you, what is their conflict? They want your money with them. And if the market conditions are bad, they still want your money with them. In a bear market, we'll talk about this later, but they may be conflict of interest there. And then this may be the best. It depends. There's nothing good or bad about these. It just depends. An hourly rate may be the best approach for most people that just want to have a little bit of advice here or there. As they talk to you, they will get paid. So they will listen to you. They will want you to talk to them. So they get paid. And that could be a good thing. They will help you either give advice. They won't manage your money necessarily, but they will give you advice about what to do on your own. The compensation will affect how they advise you. So you're kind of making this more clear. Things are fine. It doesn't matter, commission-based, fee-based, hourly. It doesn't really matter if the markets are doing well and your portfolio is growing. It's really not that big a deal. The big deal comes in a bear market, or if somebody is doing something that is serving their needs and not yours, especially if you're clear about what you're doing and your goals. Yeah, they say something else. Bear market. So assume that the market's been going for 6 or 7 years, and all of a sudden the economy starts going down, the unemployment rate goes up, all the things you talk about in terms of fundamental analysis that you see, consumer confidence, the stock market's falling. This is a bear market, and it usually lasts about a year, if not longer, sometimes. These things are persistent. They just randomly start. Bear markets occur, they exist, and we can do things to protect or not. If there is a bear market, and things are not, and your portfolio is losing money, a commission-based advisor would say, you should trade these stocks, you should buy these stocks, you should go this through me. Switch to this, change this, get away from this and get into this, because they're getting commission off of that. That may be good, may be helpful, but they are getting a commission to get you to change your portfolio through them. May help you out, assuming if you're going from something risky to something conservative. Nothing wrong with that, but realize they will want you to trade or switch your portfolio. Those who take an annual fee, this is a problem. If they know, and trust me, a lot of professionals, at least they should know, what's the broader economy, good, bad, neutral, favorable, unfavorable, bonds are favored, stocks are favored, they should know this. That's their job. I've had this happen to me, and I know this happens, where they tell you, even if you come and say, I'm really scared, I think it's a bear market, I want to get out. They will look you in the face and tell you, don't worry, it'll come back. Stay in the market with me, by the way. Don't worry. Right? If they know that the market's going bad and you know it too, you're still in the market losing money. So that I think is a difficult thing for those who pay annual fees for someone to manage their money for them, assuming that they are not making an adjustment appropriately. Well, what if you're taking the exact same, I'm scared, bear market, I'm really fearful the bear market will exist. You tell them, the economy, they would tell you, the economy's bad. Okay, you get that, they get that too. Go into bonds, protect. They're giving you advice for you to do that by yourself. And so you can do that. So maybe you protect yourself in the bear market, but the way you ask for advice and the way they are paid, through commissions, through fees, or through hourly rate, can have a different outcome. How the commission or compensation will affect their advice. And believe me, if you ask for mutual funds, they're probably going to, once again, say, our mutual funds are the best. Because not only do they get a commission for that, they get bonuses and things like that. So they want you in their mutual funds. May not be horrible, but nonetheless, that is a conflict you can avoid certain ways. It's something at least to consider when picking a financial advisor. There are different types of people that give you investment advice, like that, or manage your money. So a financial advisor will help you specifically with portfolios. They probably won't know, they probably won't be trained, or probably won't have that much of an interest in what is it like to plan a wedding, or planning college retirement, or planning this and this and this. They will help you select between bonds, stocks, ETFs, whatever the portfolio thing is. They'll be an expert in portfolios. But you don't have a portfolio. You have a 401k, maybe you have an investment thing, maybe a trading thing, but you also have bank accounts and savings accounts and things beyond the stock market. They will help you with the stock market. They won't help you in other areas. You'll turn to a financial planner for those sort of things. You're making a transition in your life. Are you getting married? Are you getting divorced? Whatever the case is, are you retiring? A planner will go beyond the stock market and will help you in other portions of your life. An RIA, which is a registered investment advisor, typically will help you pick your own stocks. They won't manage money for you necessarily, like an advisor will or might. They will actually tell you, this is a good bet, this is a good thing. They may be paid on commissions, but you're getting good quality advice to do on your own with it as you will. A trading coach is a little more specified thing for the stock market. Those who are more active and want to do swing trades or trading strategies, a little more aggressive, you go to trading coaches or trading educators to teach you how to trade the stock market. That's a service that I provide. So I typically teach trading as opposed to managing money. There's a service for that. There are lots of people that do that. They teach how to trade, how to manage risk, maybe about psychology, as I'm afraid or I'm greedy or fearful, whatever the case is. A coach can help with that. And then finally, what do you want? Ask questions. Talk with them. They're paid to listen. They're paid to give advice. But they can't give you advice unless you communicate directly to them. What are your goals? What do you want? What are your family's goals? And once you have that established, who can help you? A straight-up portfolio person? A broader money management as a financial planner for your entire life or your entire income? A person that tells you what stocks to buy in your own account? Or those that help you to trade and aspects of trading? So think about that. It's fine as for help. An entire industry exists for it. But you can ask for help at picking stocks, portfolios, managing the entire finances, the whole picture. And advice is usually similar in similar situations, retirement, all this one. They'll give you the same advice for the most part, but the compensation will determine what type of advice that you get. And you want the best. It's your family, it's your future. Do your research, and you'll typically get a better outcome than just walking up to your first financial advisor and saying, here's my money, manage it.